Welcome back to Crypto Mindset Minutes. In this session of the core mechanics of the fiat system, we're going to get our hands dirty and look at the inside of this machine. We've already learned the difference between money, currency, and legal tender, the foundational lie that the system is built on. Now, we're going to trace the machine back to its origin. To do this, let me start by asking a question. What if one of the biggest financial panics in American history wasn't an accident? Let me ask another question. What if this panic was the crisis needed to pass a law that would forever change the relationship between the American people and their money? Well, in 1907, the nation was plunged into chaos. Bank runs were rampant. People lost their life savings, and the economy was on its knees. The official story is this panic proved the need for a central backstop, a lender of last resort to prevent a disaster like this from ever happening again. The solution was the Federal Reserve, which was created in 1913. But what if the panic was the excuse, not the reason? What if the Fed wasn't created to solve a problem, but to centralize power? To find the answers to these questions, we have to go back to the scene of the crime. Let's start by looking at the facts around the era leading up to 1913. At this time, the United States didn't have any central bank. The banking system was a patchwork of thousands of independent, smaller banks, and their currency was backed by gold. But the system had a major flaw. It was prone to seasonal liquidity crunches. For example, during harvest time, farmers need to draw their money out of the bank to conduct business. This would obviously drain cash from city banks and sometimes cause them to fail. These were real, localized panics. But the big one, the panic of 1907, was different. Let me break it down for you. It began in October of 1907, when the Knickerbocker Trust Company of New York collapsed. This failure was triggered by a failed speculative scheme that involved an attempt to corner the stock of the United Copper Company. As reported by the Federal Reserve History Archives, the failure of the Knickerbocker Trust caused a massive run on trusts and banks all across the city. Fear spread like wildfire. People lined up around the block to pull their gold out of the banks. The system froze up. There was no lender of last resort. The government had no mechanism to inject cash into the banking system to stop the panic. So what happened? A private individual, J.P. Morgan, stepped in. As documented by historian Ron Chernow in his book, The House of Morgan, J.P. Morgan, who was the most powerful financier in the country at that time, took charge. There's a link in the description for you to get this book off of Amazon. It would probably be worth a read and give you some good insights as to the foundation of the Fed. But as the book details, Morgan locked the doors of his Madison Avenue library, and over some tense days throughout the month of November, he summoned the presidents of New York's other leading banks and trust companies into meetings. He used his own money and obviously immense influence to force them to work together. He even pledged $25 million of his own funds and arranged for the others to do the same. Ultimately, they used that to prop up the system. He effectively acted as the nation's private one-man central bank. Needless to say, the public and politicians were horrified by this. They realized that the entire economy had been saved from collapse by one man. Thus was born the narrative, this must never happen again. We can't rely on a private citizen. We need a public institution, a central bank, to provide that emergency liquidity and prevent future panics. This was the problem the Fed was created to solve, to act as that lender of last resort, and to manage the nation's money supply to ensure economic stability. So, in 1913, a secret meeting of the nation's top bankers and politicians was held on Jekyll Island, Georgia. Shortly after that, the Federal Reserve Act was passed. The full story of this clandestine meeting, where the blueprint for the Fed was designed by the very men who are going to benefit from it, by the way, is brilliantly detailed in G. Edward Griffin's book, The Creature from Jekyll Island. If you want to understand the true origins of the Fed, you can find a link for this book in the description and also on the My Toolbox page of my website. So the act I just mentioned created the Federal Reserve as a quasi-governmental entity with unique and unprecedented power. It granted them a monopoly on the creation of money and credit. It was given the authority to buy government debt, to issue its own currency that we know as Federal Reserve notes, which of course were made legal tender for all debts, public and private. Okay, so now you know the history. But let's take a deeper look at the Fed's mandates and what they're actually supposed to do. So with all this power that was given to the Fed, they were also given a supposed mission, a two-pronged mandate that's supposed to be the heart of everything that the Fed does today. The first mandate is maximum employment. So the Fed is tasked with managing the economy to create as many jobs as possible. The second mandate is stable prices. They usually interpret this by keeping inflation around 2%. But here's the thing. These two mandates, they're often in conflict with each other. I mean, create jobs, stimulate the economy. So to accomplish this, the Fed often has to print money, which causes inflation. Then, to fight that inflation, it has to raise interest rates to slow the economy, which causes job losses. It just doesn't make sense, does it? Anyway, throughout its history, the Fed has been forced to juggle these contradictory mandates. But here's the thing. The game changed completely in 1971 when then President Richard Nixon took the U.S. off the gold standard. Before 1971, the Fed's ability to create money was at least restrained by their need to maintain the convertibility to gold. But after 1971, that restraint was gone. The Fed was free to print as much money as it deemed necessary to fight unemployment or prop up the market. And of course, in the process, making the stable prices mandate much harder to achieve. In the decades since removing the peg to gold, this juggling act has become even more difficult. And the Fed's supposed independence from the government has been called into question many times. With the government running massive deficits and relying on the Fed to purchase its debt, the central bank is increasingly seen not as an independent steward of the economy, but as an arm of the US Treasury, basically forced to keep interest rates low to enable government spending, even at the cost of its stability mandate. So, how does the Fed manage this juggling act? The primary tool that they use is to control interest rates. And now, let me just clarify something. It doesn't set the rate that you would get like on a car loan. It sets what's called the federal funds rate. This is the interest rate that commercial banks charge each other for overnight loans. That rate becomes the benchmark for all other interest rates in the economy. The Fed makes these decisions through its Federal Open Market Committee, otherwise known as the FOMC. This is a group of top Fed officials and governors who meet 8 times a year. I've covered a number of these FOMC meetings on my channel, so go ahead back and check some of those out. So now, what do we see at these meetings? Well, if the Fed wants to stimulate the economy and create jobs, it lowers the federal funds rate, making it cheaper for banks to borrow money, which, in theory, means that they then pass that on to consumers and businesses. But if the Fed wants to fight inflation, well, then it raises the rates, making borrowing more expensive and, in theory, slowing down spending. But the Fed has another, more direct tool to inject money into the system, the repo market. Now, the word repo, in the case of the Fed, stands for repurchase agreement. Think of it like a high-stakes pawn shop for banks. When a bank needs cash overnight, it can sell some of its assets, like government bonds, let's say, back to the Fed, with an agreement to buy them back the next day at a slightly higher price. The difference in that price is the interest rate. So, for example, a bank might sell $1 billion in bonds to the Fed for $999 million. But then they buy them back the next day for $1 billion. The Fed gets a guaranteed return, and the bank gets the liquidity it needs to meet its obligations. This is how the Fed acts as the lender of last resort at an institutional level, basically preventing any kind of overnight liquidity freezes, even though we've seen some in recent history that cause panics and have caused panics throughout history. So now you understand the official story, the official history, the mandates, the mechanics of interest rates, and of course the repo market. But now it's time for my take on what this machine really was designed to do. Okay, let's hit the ground running. My take is that the official story of the Federal Reserve is nothing more than a beautiful lie. It's a fairy tale, a story we've been told time after time since we were in grade school. Some benevolent institution that was created to save us from the chaos of the free market. The calm, rational hand at the tiller of the economy. It's a story of public service, a mandate to create jobs, and of course, keep prices stable. Okay, enough of that. But when you look at the history, the mechanics, and let's not forget the consequences, a different story starts to emerge. The Fed isn't some neutral referee. It's not a public servant. It's the ultimate expression of a system that was never designed for the people. It's a machine built for the elite. And its primary function is not to manage the economy, but to manage the power of the money itself. My take is that the Fed's origin story is a classic case of crisis exploitation. How many times have we heard politicians say, "Don't let a good crisis go to waste"? I've outlined the facts, the panic of 1907, JP Morgan's intervention, and the secret meeting on Jekyll Island. But now let's take a look at its meaning. That panic, it wasn't an accident. It was a crisis needed to pass a law that would never have been created without it, and has forever changed the relationship that we, the American people, have with our money. The Fed was not created to solve a problem, but to centralize power. The men who designed this system, they weren't public servants. They were the very bankers who stood to gain the most from the creation of a central bank. They created a system where the power is to create money. The power is to set interest rates. The power is to bail out their own friends. The power is concentrated in the hands of a few, and sadly, they are insulated from public accountability. And my take is that this wasn't the first time that they tried to do this. Bankers have been trying to co-opt the government into creating a central bank for over a century. Let me give you some examples. Alexander Hamilton's first Bank of the United States was a similar attempt, a private institution with a public charter, designed to give a small group of elites control over the nation's credit. It was eventually shut down because the people saw right through it. They saw it was a tool for the rich. The second attempt was the Bank of the United States, and it met the same fate. As a matter of fact, Andrew Jackson famously declared, "The bank is trying to kill me, but I will kill it." He saw the threat that a central bank actually posed to democracy. The Fed of 1913? Well, that was actually the third attempt. But by this time, bankers had learned from their previous mistakes. They made the Fed look more public, more accountable. But really, they made it more powerful and more insulated than ever before. My take is that the core of the Fed's design is its inherent conflict of interest. It's a quasi-governmental entity. It's not part of the executive branch. It's not part of the legislative branch, nor is it part of the judicial branch. It's its own branch, supposedly answerable to Congress, but as we've seen since 1913, it's basically answerable to no one but itself. It is a cartel of the most powerful banks in the world, and they've been given a monopoly on the creation of money and the power to print it at will. My take is that their two-pronged mandate is a joke. It's a smokescreen. Maximum employment and stable prices? I mean, they're fundamentally incompatible goals. The Fed is forced to choose between them, and it always chooses to protect the banks. When the economy is booming and inflation is rising, the Fed raises the rates, which slows the economy and then, of course, causes unemployment. But when the economy is crashing, the Fed lowers rates, prints up some money, which of course saves the banks and the stock market, while simultaneously devaluing your savings and your paycheck. The Fed doesn't manage the economy. It manages the wealth for the elite. It is the ultimate tool of wealth transfer from the middle class to the financial class. My take is that the repo market is the Fed's secret weapon. It's the mechanism by which it can inject trillions of dollars into the system overnight without any public debate and without any congressional approval. Frankly, without any accountability. It's the ultimate expression of the Fed's power. The ability to basically print money out of thin air and hand it to their friends. And all while you and I are left to deal with the consequences. And my take is that the independence of the Fed is a myth. The Fed is not some independent agency from the government. It is the government's most powerful tool. It is the engine that allows governments to run massive deficits, to fund endless wars, to bail out industries that are failing, to keep the stock market artificially high. The Fed is not a check on government power. It's an enabler of it. It is the reason we have, as of the recording of this video, a $39 trillion national debt that's literally growing by $1 trillion every 90 days. It is the reason why the stock market is detached from the reality of the economy. It is the reason we have a currency that's slowly losing its value. My take is that the Fed is not the solution to the problems of the free market. It is the problem. It is the machine that was designed to centralize power, to concentrate wealth, and to ensure that the system always works for the people who own it. It is the ultimate expression of the fiat system. And this is the reason we need to understand it, to see it for what it is, and of course, to prepare for what comes next. So, now that you know how the machine works, it's time to decide what you're going to do about it. Okay, hopefully I've been able to help you to understand that the Federal Reserve is not a broken system that is in need of reform, but rather it is the machine operating exactly as it was designed. Its purpose is to transfer wealth from you to the financial elite using inflation as a hidden tax and, of course, debt as the shackles. Knowing this, your move is to opt out of their system. Your move is to stop playing their game. You can't fix their machine, but you can build your life outside of its reach. This means removing your wealth from their system. Your move is to take your savings out of this inflationary currency. Exchange it for assets that are not created by a central bank, assets like gold and silver that you hold yourself. For those of you looking to bridge the physical and digital worlds, platforms like Kinesis will allow you to hold these physical metals that are digitally represented on their platform, and honestly, you can then spend them for everyday transactions. And if you don't have a Kinesis account, getting one is pretty easy. Just use the link in the description below or on the My Toolbox page. Sign up, verify your identity, and there you go, you're good to go. Oh, and by the way, if you use my link, you'll be eligible for some silver, so go check that out. But if you prefer something you can hold, but something you can still spend every day, then you should consider goldbacks or orums from Metalmark. These are physical, spendable gold notes designed to be used like currency. Links to both of these are in the description and on the My Toolbox page of my website. And when you go to Metalmark, if you use my link, you're going to save 5%. So check both of those out. For those who are truly digitally inclined, your move is to start using sovereign, decentralized money, otherwise known as cryptocurrency. Your move is to consider living on cryptocurrency, just like others are currently doing. While cryptocurrency can be a good investment, it can be much more than that. This can be your first step toward your financial sovereignty. While Bitcoin is the king for savings, for actually living on crypto, I'm going to suggest you try Dash. Now, Dash is purpose-built for daily transactions. With its InstaSend feature and low fees, it is the perfect way to start living on cryptocurrency today. As a matter of fact, I have a link in the description to a playlist where I show you how you can do exactly that. Live on crypto using Dash today. So go ahead and check that out after this video. But when you decide to move into the crypto space, you're going to need something that holds your keys to your crypto assets. Because if they're not your keys, they're not your coins. I realize that if you're new to crypto, the statement and the words "your keys" probably makes no sense. While I will eventually get to an entire Crypto Mindset Minutes episode about cryptocurrency keys, For now, I've included a link in the description of this video to articles on my website that outline and explain these in perfect detail. So check those out. The links are in the description. But for now, know that in order to take control of your keys, which is necessary to control your cryptocurrency, you're going to need a cryptocurrency wallet. There are many different types of wallets. Some are free, some you have to buy, and they all operate in different environments. As you buy your crypto, your move is to remove that Bitcoin or whatever other cryptocurrency you've decided to purchase off of the exchanges that you purchased them on and move them into a self-custody wallet where you control the private keys. There are links in the description and on the My Toolbox page of my website, and there you'll find my preferred exchanges and wallets, so take the time to check those out. But let's give you a few more moves to help you extricate yourself from the fiat system. Your move is to stop participating in their debt-based economy. Learn to use credit strategically, not for consumption. To help you understand this principle, I'm going to link to a video in the description that I did with two very knowledgeable and successful people that operate here in the cryptocurrency space. We talked about this very topic. So go ahead and check out that video when we're done here. But in short, pay down your high interest debt, because that high interest is making you a slave to their interest rate manipulations. But there are more options to insulate yourself and your wealth. Your move is to build your own central bank, a central bank of one, or maybe two if you have a family. Become your own source of liquidity. This means building up an emergency fund, creating multiple streams of income, and developing skills that are valuable regardless of economic conditions. Finally, your move is to educate yourself. Learn the entire story of how the Fed was born by reading The Creature from Jekyll Island and The House of Morgan. The links again to both of these are in the description. You can get them right off of Amazon. Look, the bottom line is this. The machine thrives on your dependence and your ignorance. By becoming financially independent and educated, you break the machine's power over you. They built the machine for their benefit. Your move is to build your life for yours. It's your move. I'll see you in the next episode.